Wasn't corporate finance. Free cash flow to the firm. We did in class here. That wasn't from corporate finance.
No, that's something is the accounting. So
Yeah, but that's not a corporate finance firm. That's an accounting firm. Because
okay.
we never did that in corporate finance either.
So, any suggestions for me? Where can I find it?
Go back and review financial statements because that's all it was. So actually, we never did that directly in corporate finance.
I was about to search your videos to take a look at it.
Yeah.
Because the first three I did okay, just the last one, no idea.
Yeah, I think it might be an accounting problem.
Accounting problem. Okay, thank you.
Okay.
I just wanted to introduce you. I have a group of prospective students
Hi,
here.
nice to meet you. Sit in the front if you want.
Yeah, I'll sit here. These are other prospectives. This is Professor DeMonaran.
Hi, nice to meet you.
I have the sheets.
Nice to meet you.
Nice to meet you.
Nice to meet you. Anywhere you want. You can take that.
Thank you.
Okay. It's a chance to win some prizes here. You get my email this morning? I thought about it. I was going to fix it and put it on and not even mention it, but I thought it'd be actually a better learning experience if you could tell me what I screwed up on in this valuation. Anybody have a chance to look at it? In fact, it's staring at you right there, right on this sheet. You don't even have to dig deeper. It's not a deep assumption. Don't think too much. You can actually spot this mistake by just looking at this page. What? Country of, yeah, that's that I can. It's actually, it is incorporated in the Netherlands. Don't ask me why. Okay, so that's actually right. Though it doesn't really matter because my equity risk premium is not based on where it's incorporated. I'm sorry. Yeah, they will not. So in a sense, as I said, the value of equity is what I'm focusing on. You said marginal tax rate I can live with because you could argue it's going to be some kind of a global average tax rate. Come on, do you want me to give you a clue? Yeah. Oh, it is actually 1.25 years, and the reason I had to do 1.25 years is the last fiscal year, that's 2013, the trailing 12 months is through March of 2015. So what I report as the last fiscal year is 2013. Since the last 12 months are from the first quarter, it's actually been a year and 3 months since the last one. So that's why it's 1.25 years. Yes? Oh, you guys are thinking too deeply. I mean, as I said, it's much more straightforward. There are lots of arguments. You can argue about my return on capital, my margins, my sector. I have to give you the clue. What currency are my cash flows in? Take a look at my risk-free rate. I screwed up, and here's why I screwed up. When I initially valued Ferrari, I was doing everything in US dollars. Then at the last moment, I said, might as well switch to euros. So I did the easy switch, which is to take all the dollar numbers and replace them with euro numbers. What I forgot to do, though, was fix my risk-free rate. Okay. Let's fix it. Let's see what difference it makes. Okay. So it should be about, I think 0.7% is the German 10-year bond rate this morning. 0. Well, magically the cost of capital also goes from 8.23 to 6.96. But to finish the story, though, what else do I need to now fix? What else is in dollar terms that I now have to replace with euro terms? I have growth rates right there, right? And I was thinking through the growth rates. I was thinking dollar growth. Now I have to, you see, what difference does it make? Growth is growth. The inflation rate embedded in them is about 1%. There's a difference of about 1% between the dollar bond rate and the dollar inflation rate and the euro inflation rate. So my 5% growth rate should probably become a 4% growth rate. The rest the spreadsheet actually takes care of. My terminal growth I actually adjust to the risk-free rate. So the spreadsheet kind of lets your valuation not go off the tracks completely. So I have to change the growth rate to 4%. And there's one more number that I need to fix. If you look at the bottom, I said, do you want me to change the cost of capital? The 8% is actually an average cost of capital for a mature company in dollar terms. I'm going to knock that down by 1%, just again to make that all consistent with euros. So those are the three changes I'm made. What is the value that I sent you yesterday? Do you remember? It was actually about 6 billion euros, I think, in the status quo. The value that I get now is about 6.3 billion euros. It's 300 million, take it or leave it, right? So I screwed up, and I'll fix this and put this back on. So, okay, that's why when you switch currencies, you got to be careful that everything kind of adjusts with it. It's not just change. So, in fact, if this had, the reason I did not notice is, you know why? Because I was going from dollars to euros, and it's easy to be sloppy. If I'd gone dollars to pesos, or pesos to dollars, or reais to dollars, it would have jumped out at me. So it's actually much more obvious when you have those big differences in inflation that you're going from a high inflation to a low inflation currency. Okay? So keep that in mind as you look at this valuation. I'll fix both and put them online so that both Ferrari valuation, and actually I give you two narratives for Ferrari. The first is what I call the status quo. What's the status quo with Ferrari? It sells about 7,255 cars a year. It's been selling around, if you think about it, 7,300 cars is nothing in the overall car market, but it does get fairly significant revenues of those 7,300 cars. Why? Any of you own a Ferrari? I just want to make sure that I'm in the right crowd here. Okay? It's about $500,000. So basically they get revenues from, but they're able to charge $500,000 because they make only 7,300 cars. So part of this is the scarcity. So the first valuation I did assumes that they keep a low growth model, which doesn't mean they will refuse to sell you a Ferrari, but they're not going to knock it down to a Maserati price, which is only 150,000, I guess. So in the first valuation, I left the growth low because the number of units is not going to go up. I left the cost of capital relatively low. You know why? Even though it's a luxury good, by keeping the number of units fixed, what's it doing? Who buys Ferraris? People who really don't notice what's happening to the economy. Why? Because they're so rich that they really don't care. Recessions, recoveries, you what, 15 billion versus 13 billion, who cares? Okay? So by keeping the number of units low, they get this narrative where they have high margins, low growth, and a relatively low cost of capital. They could go with a different model, right? And Maserati, for instance, doubled its sales by bringing out the Ghibli for 150,000 and essentially doubled its sales. So you can go for a higher growth model, but that'll mean lower margins and potentially opening yourself up to more risk because now you become a luxury car that people will buy. So I actually value the company using both narratives, and you can think of a third one, add that in there. And the value that I get is, I thought a pretty high number for a company which sells only 7,300 cars of about 6.3 billion euros, which translates in about $7 billion, which is well below what people are saying the company is going to be priced at. And if you look at the last part of the challenge, I said, where's the premium? Because that's the word you hear. Ferrari is a big name, one of the great brand names of all time. You should have a premium. And what I tried to show is the 6.3 billion is about 2 times revenues. The typical auto company trades at less than 1 times revenue. At 6.3 billion, I am paying 23 times earnings. The typical auto company trades at 11 times earnings. So where's the premium? It's already in there. If I add a premium on top of this, I'll be double counting. So there's all this very sloppy talk you will hear about premiums for brand names as the IPO gets closer. It's mostly lazy talk. It's lazy talk in the sense people want to justify getting into the IPO. They will use the brand name to justify getting into it. I'm not saying brand name doesn't have value. I've attached a significant value to it. But it's our job to attach values to these brand names. So give it your best shot, and maybe you can come up with a third narrative that gets you to $10 billion. I'm curious. I'd like to know what that third narrative is. But you want to make sure you don't cross the line between possible and plausible, right? Lots of things are possible, but you want to value the company on a plausible scenario. So we'll come back to this when we get to storytelling, because it's a great company built around storytelling. Okay? Do you guys read about the InBev, SAB Miller deal? How can you not, right, if you open up the paper? Huge deal, right? How much did SAB Miller's market cap increase as a consequence of this deal if you go back about a month when the deal rumors started? The premium was about, basically we add up all the numbers, it was about a $15 billion increase in market cap since the rumors got started. You know how much InBev has lost in value in that same period? About $15 billion. You know what the market tells you the value of synergy in this deal is? It's 0 or less. This is a bad, big deal. But the big is overwhelming the bad because, let's face it, a lot of people in this ecosystem make money off big deals. There's bankers, there's consultants, there's strategic thinkers coming out of every corner with every conceivable strategic reason why this is okay. It is a dumb, big deal. And I read it described as a bold move. Bold moves are when you use your own money. Dumb moves are when you use other people's money. This is Carlos Brito using your money and my money essentially because he wants to be the CEO of the biggest beer company in the world. It happens. It's a story of big deals through time. How many big deals do we read about 10 years after and say, hey, that was a good deal? Okay. So we'll see how this plays out because maybe they know something we don't. Because I really don't see the synergy here. Are you going to pay a higher price for your Miller or your Bud Light because they're now one company? I don't see that happening. In fact, they might be forced to sell some of their businesses because of antitrust laws. So if anything, what I see is bad stuff coming out of this deal rather than good stuff. Hey, but I don't know the beer business. Maybe Carlos Brito does. So we'll see how this plays out. Okay? So let's take today's issues. And, oh, I'm sorry, this is not the one that I wanted to pull up. That was last session. Actually, let's jump into the slides today because I don't want to, let's go back to the, let's go to the growth rate discussion we were having about fundamental growth. And remember the drivers of fundamental growth, right? It's how much you reinvest, how well you reinvest. And last session we talked about how that plays out when you're trying to estimate growth in earnings per share. Somebody help me here. How did we measure reinvestment with growth in earnings per share? It's whatever you didn't pay out, right? The retention ratio, bounded between 0 and 100%. And the return on equity is what you make on your projects, defined as net income over book equity. But even as I described that, I talked about the problems. I said what you don't pay out as dividends doesn't exactly get reinvested in projects. It might be held as cash. And what you claim as return on equity is a composite of both what you're making on your regular projects and what you're making on cash. I think this is a practice that we need to increasingly turn to because companies are starting to get such large cash balances. You almost have to separate companies into two businesses. One is whatever business they're in and the other is the cash business. So let's face it, Apple is $540 billion in the smartphone computer technology business, $160 billion in the cash business. Well, lots of things. I don't want to get into that particular cesspool right now. But U.S. tax law is a big reason, a big culprit for the cash accumulation because it taxes companies on their global income rather than their regional income. So it's a big culprit, but there are other factors also coming into play. Many of these companies used to be growth companies. They want to go back to being growth companies. So there's that aspect of delusion as well, is they wait long enough, they're going to find this great project. And to give them cut them some slack, these are technology companies. They have a lot of cash today. Everything looks great today, but everything looked great for BlackBerry 6 years ago, right? So these businesses, you can overnight, in a sense, go from being incredibly successful to having very little. So some of this is that uncertainty about what the future will bring and what they need to do. But whatever the reason, cash balances are accumulating. So when you look at companies, you have this big cash balance lurking in the background. So here's one way you can do it. Rather than focus on retention ratios and return on equity, focus on your non-cash net income. You're saying, what about the cash net income? Cash is the easiest asset of all to value, right? What did we say about cash? Just count it. Just let it go. Why bring it into your valuation and let it mess things up? Separate the cash from the non-cash net income. And rather than measure what you retain, here's what I'm going to do. I'm going to look at what you put back into the business. And we know how to measure that, right? From the cash flows, net capex and change in working capital. And because some of that might be covered with debt, I'm going to give you that debt benefit. So let's say that you have $100 million in reinvestment and $25 million of that comes from debt. Only $75 million has to come from you as equity investors. I'm going to divide that by your non-cash net income. I'm going to come up with what looks like a retention ratio, but it's essentially a reinvestment rate that I've computed. So if you're a company that retains a lot of cash, retains a lot of your income, but keeps it all as cash, your equity reinvestment rate is actually going to look really low because you're not putting it into real projects. So this is a measure of what you're actually doing rather than just taking your word for, hey, I'll find something to invest in. And when I look at your return on equity again, I'm going to stay focused on your non-cash assets. I'm going to take your non-cash net income, which is net income minus the interest income from cash, net of taxes, and I'm going to divide by your non-cash book equity. You're saying, what the heck is that? It's your book equity net of your cash balance. And again, be ready for unpleasant things to happen. We talked about this, where your cash balance can exceed your book equity, in which case your non-cash return equity becomes not meaningful. It's not a negative number, right? But the product of those two numbers will then give you your expected growth in non-cash net income. So enough talk, let's try a company. Let's suppose you took Coca-Cola. Coca-Cola had net income of $11.809 billion in 2010. Its book equity was $25.3 billion. So that's from the traditional accounting statements. The cash balance was $7 billion. And it earned an income of $105 million in the cash. Incidentally, if your company does not report its interest income from cash, you can always estimate it, right? What did you do? Sorry? Take a short-term risk-free rate, not even the long-term rate. Take a one-year T-bill rate, multiply it by your cash balance, let it go. It's not going to be that off anyway. So it might be 0.5% instead of 1%, big deal. Okay? So take that non-cash net income, which is in this case, cash net income of $105 million. So here's how I'm going to compute the numbers. Coca-Cola had actual capex of $2.2 billion. So that came right out of the statement of cash flows, depreciation of $1.4 billion, and working capital increased by $335 million. So those are the traditional numbers we look up in the statement of cash flows. Its total debt increased by $150 million during 2010. So that's the debt they took on. So let's work out what the numbers look like. To compute the equity reinvestment, I'm going to take the capex, subtract out the depreciation, add the change in working capital. So that's my total reinvestment. And because I'm looking at just the equity portion of that, I subtract the debt from it. The total equity reinvestment during the year was $957 million. The non-cash net income, if I subtract out the cash income, is $11.7 billion. The non-cash book equity drops by $7 billion, the cash balance. So my reinvestment rate, if I take the 957 and divide by 11.7 billion, is only 8.18%. You see, that's really terrible. What does Coca-Cola reinvest in? It's a mature company. It's not building plant and equipment. The bottling is split off anyway, so it doesn't even have what some beverage companies have of building up plant and equipment. It's making more syrup. How much does that cost? 1 cent a no, I don't know, 1,000 ounces or something. Basically, its costs are very, so I'm not surprised it's not reinvesting very much. Its return on equity is astronomical. Why? Because it has very little in terms of physical assets. You multiply the two numbers, you still get a pretty decent growth rate of 5.22%, but it's coming from this astronomically high return on equity, which comes from the fact that it's basically milking a brand name to make insane amounts of money. That's my expected growth. And if I were valuing Coca-Cola, what I would do is take the non-cash net income, grow it at 5.22%, get the value of the equity without the cash, and then what would I need to do is before I get to my final valuation, I have to add the cash, because I've kept it separate, subtract out the debt, and I'll have a value of equity in the company. So, I'm sorry, not subtract out the debt, add the cash and leave it at that, because I already have the equity value in my non-cash assets. So the second approach, the reinvestment rate, shifts from my retention ratio to a reinvestment rate. My return on equity goes from a conventional return equity to this non-cash return equity. My growth rate goes from being a growth rate in earnings per share to a growth rate in non-cash net income. Everybody comfortable with that? Because I'm going to make the third shift now. Go ahead. That's a good point. If I capitalized advertising, my numbers would change, right? My reinvestment rate would go up. What's going to happen to my non-cash return equity? because now I'll create an asset on the advertising. My non-cash return on equity will go down. So that's a good point. If you want to take that extra step, that's where you're going to notice it. You're going to have a higher reinvestment rate. Will it help or hurt Coca-Cola? Until we bring it in, it's tough to tell. But I think that that's what you'd expect to see as changes. And that's always going to be the effect of capitalizing R&D or any other operating expense. Push up your reinvestment rate, push down your return on equity. Now let's talk about growth in operating income. So we've gone from retention ratio to equity reinvestment rate. Now we're talking about the entire business. Now, rather than focusing on what the equity reinvestment rate is, I'm going to look at reinvestment overall as a percentage of after-tax operating income. I want you to notice how we're shifting our lenses as we move from equity to the firm. We've gone from net income to after-tax operating income, from equity reinvestment to total reinvestment. So it's going to be net capex plus change in working capital divided by after-tax operating income. And when you ask me how good are my projects, rather than focusing on return on equity, I'm going to look at return on capital. Return on capital is after-tax operating income divided by the invested capital in the firm. Invested capital is, in addition to book equity, I'm going to take on book debt and I'm going to subtract out cash. Why add back book debt? Because, in a sense, debt is also paying for my investments. I've got to count it as part of invested capital. So we've gone from equity reinvestment rate to full reinvestment rate, return on equity to return on capital. The product of those two numbers is my expected growth rate. We often talk about the quality of growth, or we should talk more about the quality of growth. We get caught up in the level of growth. One way to think about the quality of growth is to see where it's coming from. And I'm going to give you a very simple exercise in a couple of minutes so you can tell me what kinds of companies have high quality growth, which ones have neutral growth, and which ones actually destroy value as you grow. But it's going to come out of realizing that growth comes from how much you reinvest and how well you reinvest. Okay. So here's an example of how this plays out. This comes again from my 99 version of my Dark Side of Valuation book, when Cisco was a superstar and Motorola was not. So in 1999, I estimated the numbers for Cisco, and I'll talk a little bit about the dangers of how these numbers shift over time. But in 1999, this is what Cisco's numbers look like. Its reinvestment rate was 107%. And actually, the way I estimated that was I counted acquisitions as part of capex. So we went through that process of defining, so they have a high reinvestment rate. Half the equation is done, right? But what was even more impressive about Cisco was the return on capital was 34%. You reinvest a lot and you reinvest well at the same time, you're going to have an insanely high growth rate, and it's going to increase your value dramatically. So that's Cisco. Let's take Motorola. Its reinvestment rate is not bad, 53%. Its return on capital is not bad, 12%. You multiply not bad by not bad, you get not bad, 6%. And that's something to remember. It's obvious, but all too often managers want to take not bad and come up with insanely good. Can't come up with it. It's a multiplicative effect. So it reinvests fairly well. It reinvests a fair amount, but fair amount times fairly well gives you a pretty average growth rate. Would Cisco like to grow like Motorola? Sure. Would pigs like to fly? Yes. I'm not calling, I'm sorry, would Motorola like to grow like Cisco? I've switched the question. Cisco doesn't want to grow like Motorola. Motorola grow, of course. All companies want 35% growth rates, and you can see very quickly that it's not going to be feasible unless you have lots of great investment opportunities right in front of you. I told you there was a cautionary note here. Cisco in 99 looked great, right? What did Cisco do in 2000, 2001, 2002? In terms of the reinvestment rate, they continued to reinvest 100%, 90%, 105%. So they're doing the same thing on the what happened to the return on capital? As you went from the technology boom of 99 to 2000, 2001, their return on capital went from 34% to 20% to 11% to single digits to middle single digits. And they kept reinvesting like it was 1999. So between 2000 and 2011, Cisco grew, if you looked at growth as, hey, they grew each year, they became bigger, But if you look at what happened to their value from 2001 through 2010, it got frozen in time. Cisco's stock price in 2001 was $38. Cisco's stock price in 2010 was $26. It's a decade, a lost decade, where they continue to reinvest as if it were 99, but the returns on capital dropped off. Things can change. And that's our job in valuation, is to try to assess those changes before they happen. After they happen, everybody can look and say, you shouldn't have done that. But that's a judgment call you're called on to make. So we've talked about 3 different ways of estimating growth: earnings per share, non-cash net income, after-tax operating income. We're really using the same equation. The only difference is how we define how much you reinvest and how well you reinvest. Any questions on those 3? Because now I'm going to introduce a twist. Because the way I've described growth up till this point, to grow fast, you have to reinvest, right? In other words, if you don't reinvest, your reinvestment rate is 0, your growth is 0. And that's a very pessimistic view of the world. You can grow, at least for short periods, but without reinvesting. But here's what you need to do. You need to make your assets more efficient. What does that mean? If you can increase the return on capital on your existing investments, you, in a sense, are going to grow, right? Let's make it very simple. Let's assume you have a company which has a 10% return on capital. Let's say next year its return on capital can be improved to 20% by cutting costs. Let's say there's an incredible fat in this company. It reinvests nothing. What's its growth rate going to be next year? It made $10 this year. It's going to make $20 next year. You're going to get 100% growth rate next year. You're sounding, that's magic. It's really not. It's the improvement in return on capital divided by your original return on capital. So you improved your return on capital by 10%, your original return on capital is 10%, you're going to get 100% growth. You're saying, why doesn't every company just do this instead of reinvesting? Well, here's the problem. You get to next year, you're now at a 20% return on capital. To keep growing with efficiency, what do you have to do? You have to make the 20% into 40%. The 40, you see already that when you talk about efficiency growth, it comes with a finite end period. You can't keep pushing efficiency beyond that breaking point because you are going to break as a company. So for short periods, you can actually use efficiency as your basis for estimating growth. And let me use this with Motorola to talk about why, in fact, I used a higher growth rate than the 6% that I computed 2 pages ago for Motorola. So in my 99 valuation, I looked at Motorola, its return on capital is about 12%. The return on capital for the sector was 22%. Now Motorola had some structural problems which meant that it could never get to the return on capital of the sector, but I did assume that over the next 5 years, it would be able to move halfway towards the industry average. So in other words, I expect the return on capital to go from 12% to 17%. I'm also going to be realistic in assuming that this isn't going to happen overnight. It's going to take 5 years for this to play out. So here's what I'm going to do. I'm going to take that difference and let's keep it simple. You're going to improve your return on capital by about 5%. It's going to take you 5 years. So roughly speaking, you're going to get about a 1% change every year, right? I actually finessed it a little bit because there's a compounding effect. What you see in this equation here, okay, is actually my estimate of the compounding effect of growth. So basically, I'm taking the compounding effect on growth by raising it to the power 1/5. That should actually be raised to the power, not multiplied by 1/5. So cross out the 1/5, raise it to the power 1/5. What I'm effectively doing is saying, if you're going to get a 40% growth over 5 years, it works out a little less than 8%, about 7% a year. My expected growth for Cisco over the next 5 years is going to be about 16%. Astonishingly high if you think about what the growth is given the traditional equation, but the extra growth is coming from efficiency. The 9% is from new investments, if you can grow it at 17.22, but the extra 7% is coming from efficiency growth. Some of you have companies where this is where the bulk of your growth is going to come from. So when you compute the reinvestment rate and return on capital for your company, you're going to come up with an abysmally low number and you're going to get depressed. You're going to look at this number and say, how the heck am I going to justify the price? I'm not saying your argument should be to justify the price, but take a look at the return on capital, because it's entirely possible that your growth is going to come from improving that return on capital. And this is especially the case if your company has 3, 4, 5% returns on capital. Do you see why? because the potential for improvement is much greater, and small changes in that return on capital will translate into much higher growth rates. Any questions on efficiency growth? Yes, sure.
Does that mean that companies like 3G Capital can only, for a limited time, squeeze out what they're doing?
Do you even need to ask the question? Of course, right? It's common sense. You can squeeze existing assets only so far. Right? It's just, you don't even need to think about who's doing it or what company. It is mathematically, it's impossible. We talk about impossible narratives. An impossible narrative will be a company that says, we're going to grow by making ourselves more efficient. We're going to keep doing it forever. That's an impossible narrative. If you tell me that you can get more efficiencies for 15 years, that's an implausible narrative because that's a long time. If you say it's 3 years, much more probable. So that's how we divide possible, plausible, probable, is asking the question, is it likely to happen? Is it something you can pull off? Okay. So you ready? For some reason, it keeps jumping 2 slides. Here's the task you face now. Now that you can think about where growth comes from, it can either come from new investments or from efficiency. I'm going to show you 5 companies. Okay? There are the 5 companies, and I very creatively named them Firm 1, Firm 2, Firm 3, Firm 4, and Firm 5. Okay? I've given you the growth rate for every company. Notice what the growth rate is for every company? It's exactly the same. They all look the same in terms of growth, but I want you to rank these companies from the company that creates the most value from growth. So think like an investor. They all look the same in terms of growth rate. But if you rank these companies from most value to growth, least value for growth, I want you to start at the top and work down. Okay? Which of these companies creates the most value from growth? They all have the same cost of capital of 10%. How do you create value? You take projects that make more than the cost of capital, right? So I've kind of given you the clue. Which of these companies has the best growth? And why Firm 1? What is it about Firm 1 that makes it so impressive? It's reinvesting relatively little. It's getting a lot of oomph when it reinvests, and it's getting a 10% growth rate. In fact, if you look at Firm 1 versus Firm 2, they have the same growth rate, but what's going to be different? Firm 1 puts all its money back into the business and delivers the same growth rate. Firm 2 puts all its money back. Firm 1 puts only 20%. The way it's going to show up is when you compute the free cash flows of the firm, for Firm 1, you're going to get a nice healthy number. When you compute the free cash flow to the firm for Firm 2, what are you going to get? You're going to get 0 because everything goes back into the business. So Firm 1 and Firm 2 look exactly the same in terms of growth rate, but Firm 1 actually is much more valuable than Firm 2, and it's going to show up in your valuation through the cash flows. But there's actually a firm even worse than Firm 2. Do you see which one it is? Look at Firm 3. That's the model that InBev is shooting for, I think, which is this incredibly high reinvestment rate. He's saying, oh no, don't be so unfair to him. This is what happens when you spend $70 billion on reinvestment. Unless you can show me insane amounts of growth, you're going to be in Firm 3 territory very, very... So their earnings are obviously going to grow next year after they've acquired Miller. But the question is, what did you pay to deliver the growth? This is the question. And so even if you never do another valuation in your life, this is what I want you to walk away, because people are dazzled by growth. They want to talk about growth all the time. Managers, investors, analysts. You have to be the skunk at the party and say, okay, that's nice, but how much did you pay to deliver that growth? Because if you pay too much, you will grow and you will destroy value. Firm 3 will get less valuable because it grew than if it had not grown at all. Firm 2 is just running in place. Its growth is adding nothing. Firm 1 is adding value. Firms 4 and 5 are interesting because they are getting relatively little growth or no growth from reinvestment, but they're getting a lot of growth from efficiency. Efficiency growth is great. You know why? What's so good about efficiency growth when it happens? There's no reinvestment to back it up. It's like free growth. The only problem, the reason I put Firm 5 over Firm 1 is I'm going to get it for only 1 year, and then it's done. right? Because after that, what am I going to do? So with efficiency growth, that's always got to hold you back. So if you get a chance, take any sector that you want. Maybe the sector you worked in, take the 10 companies with the highest growth rates. Then start breaking growth down. You now have the mechanism for separating these companies into good growth companies, neutral growth companies, and bad growth companies. And that's exactly where you want to end up with growth, is not treat it as a free bonus, but think of it as something that you pay for to see if you get back enough in return. Any questions about fundamental growth? Yes?
If a company is making an acquisition to break into a new product or a new geography, then we can't justify those in terms of the investment.
No, wait. Do you ever get paid dividends with products or geographies? Can you get? Ultimately, you go into whatever you want. You give me whatever rationale you want. What do those products and geographies have to translate into? They have to translate into earnings and cash flows. So you can give me whatever strategic story you want about why you're doing what you're doing, but the bottom line is, if you're selling me the story and you want me to do something, then you have the obligation to fill the rest of the story. Okay? So you want to enter a new product? Great. Now show me how much this new product will create in terms of revenues and margins and growth. You're saying it's too early in the process, then don't pay $20 billion now and tell me later on that you screwed up. So if you're going to enter something, then you have the obligation to fill in the rest of the details. Any questions? Now let's talk about the most general way of estimating growth. In fact, the simple FCFF simple Ginzu that most of you used in corporate finance, and the one that I've used for the Ferrari value, and the one that I use the most is actually based on this growth rate. It's the most generic way of estimating growth, and it starts with the top line and works down. What do I mean by that? I start with revenues. Up till now, the first 4 approaches have been entirely operating income based, right? So why not start with revenues? Project out the growth in revenues, and that's going to be based on what your market size is, what market share you're going to get. The second step in this process, you've got to estimate margins over time. And then I'm going to give you complete freedom. You could have negative margins now, like Tesla does, like Twitter does, and say, hey, by the time this game ends, I expect the margins to be 8, 10, 15%. Obviously, you can't make up stuff. You've got to figure out what the target margin is going to be. So think about what's happening in your spreadsheet. The revenue growth makes your small revenues into big revenues. As your operating margin improves, your losses will become profits. Saying, this is great, let me do this because I can be completely undisciplined. You see why it's easy if I just stop at those 2 steps to be undisciplined? If I don't get a high enough value, what am I going to do? I'm going to push up the revenue growth a little bit more and push up the margin a little bit more. So I'm going to introduce a third layer to this to keep you a little more disciplined. To grow your revenues, do you have to reinvest? Yeah, just like you had to grow your earnings, you had to reinvest. So I'm going to ask you, how much will you need to reinvest to get this astronomically high revenue growth you promised me? And to estimate that reinvestment, I'm going to use a ratio called the sales to capital ratio. This is a ratio you're going to see me use over and over again. But here's what it measures. Here's first what the actual measurement is. It's $1 of revenues you create for every $1 of invested capital in your company. So the higher this number, the more efficiently you're delivering growth. And obviously, this is not something, again, you can make up. It's going to depend on, if you're an infrastructure company, this number is going to be much lower than if you're a technology company. So each measures something separate. The revenue growth number measures my growth potential. The operating margin number measures my pathway to profitability. It's not just enough to grow my business. The sales to capital measure measures how much or how efficiently I'm delivering growth. 3 levers. If you use them well, this is an approach that will work for any type of company. Younger startup, you want to start a business, this is the approach I'd use. Because if I try to use reinvestment rate times return on capital for a startup, you see it's not going to work. Because the reinvestment rate obviously is going to be a negative number, you're losing money. Your operating margins, return on capital is going to be negative. Negative times negative is positive, that's very convenient. But then you put a positive growth rate and a negative operating income, it's only going to get worse over time. So this is the most general approach for valuing any company, no matter where it is in the life cycle. So revenue growth rates, target margin, sales to capital ratios. I'm going to use an example to kind of illustrate this. You guys familiar with Sirius? So this was just before Sirius bought XM. the satellite radio companies. And this was when people thought the sky was the limit for Sirius. Things have kind of cooled down for the company. So I'm going to use this approach to illustrate how you'd value a company like Sirius, which at the time that I valued it at $187 million in revenues, almost no revenues, had an operating loss of $787 million. My task is laid out for me, right? Because if you're losing $800 million on revenues of $200 million, obviously you're a company in serious life cycle trouble. Their operating margin was minus 420%. So that's the only thing I know, is they have small revenues and big losses. Now they have a lot of promise. Promise in what sense? Well, that's a big market out there for satellite radio. So the first thing I did was I projected out my expected revenues in the future. And to get that $9 billion as my target number, we'll come back and talk more about this, I looked at the potential market as I think the potential market I came up with was about $45 billion, and I gave them a 20% market share. And this is something we're going to come back and talk about how to do, because it's going to be the central first, because it means that the larger the potential market, the larger the potential revenues you can have. Last week I posted my updated valuation of Uber on my blog. I'm going to follow up with a post on Lyft. I'm going to value Lyft. In fact, it's ready to go, but TechCrunch is going to run it this Saturday. But you know what the contrast between Uber and Lyft is? Uber tells a big story. It's going to be everything everywhere, right? Global, not just car service. It's going to be logistics, transportation. Lyft is a very different company, right? It's much more focused. It's going to be only US-centric, and it's only ride-sharing. So when I value Lyft, what's going to happen to my potential market? It's going to become much, much smaller. We're not talking about a $230 billion potential market. You're talking about a $50 billion potential market. Is that going to lower my value for Lyft? Obviously, because I'm going after a smaller market. You're saying, why doesn't Lyft just go after the big market just like Uber? There are risks with big stories, right? What are the risks of telling a really big story as an entrepreneur? You might be able to get a lot of people interested in investing in you, but you've now raised the stakes. You have to be in 5 different businesses. That's going to mean that you're not focused. You're going to have to spend a lot of money, like Uber had to, the Uber Move and Uber Eats and Uber this and Uber that. And is there a greater chance you could disappoint with the big story? Absolutely. Tesla is finding this out the hard way. They've been selling this a big story right from the beginning. And it's pushed up their price, but it's also meant that there's far more potential for disappointment. So it's actually interesting to see a small narrative company versus a big narrative, because if you're an entrepreneur, you're often told, go to VCs and tell them the big story. That's an Uber path, but it comes with all kinds of pitfalls along the way. So the potential market drives this revenue going. So I've essentially been very optimistic about revenues. Revenues go from 187 million to about 9 billion. But that's not going to save me, right? Small revenues to big revenues will not save me unless I fix the other big problem, which is they're losing money. So I had to pick a target margin, and the way I picked the target margin was I looked at Clear Channel, which is the largest company in this space. Makes its money almost entirely of radio advertising. It's a different business model because it doesn't have the subscription revenues that Sirius will have. But their margin is 19.57%. That's it. That's pretty much going to be my target. I essentially allowed the margins to improve over time from minus 420% to plus 19.57%. The way they improve depends on how quickly you think the company can move from losing money to making money. So 2 pieces of the puzzle are done. Small revenues have become big revenues. My losses have become profits. What's the third piece? I have to reinvest, right? And this is where the sales to capital ratio came in. The sales to capital ratio I estimated was the average for the sector. In this sector, for every dollar in revenue, for every $1.50 in revenue, companies look like they have to invest $1. It's a big infrastructure investment you've got to make. So the way I estimated the reinvestment each year is I took the change in revenues from year to year. So let's take year 1. My revenues increased from 187 million to 562 million. That's an increase of 375 million, right? To get an extra 375 million in revenues, I have to reinvest 250. Do you see how I came up with the 3? So that's all I'm doing, is taking the change in revenue every year and dividing by that sales to capital ratio. Now you can already see what happens if I use a higher sales to capital ratio. What will happen to my reinvestment every year? My reinvestment will get smaller. So as my sales to capital ratio changes, you're going to see my reinvestment change. And that's why I described it as my third lever. That's what determines the efficiency of my growth. So there's my reinvestment every year. Just to keep myself honest, I keep track of another number. We don't think of it this way often in valuation, but when you have a reinvestment number in valuation, net capex and change in working capital, that's almost an increase in your invested capital on a year-to-year basis. So if I take my reinvestment each year and add it to my capital invested, I'm keeping track of my capital invested in this company, at least according to my estimates. So last step in the process, I take the operating income or loss I report for the company, divided by the capital invested, and I get what I call an imputed return on capital. Why imputed? Because I never really estimated it directly, but it's coming out of my own assumptions. You think, what's the point? See this return on capital in year 10, 15.81%. I'm okay with that. Okay with that in what sense? That's a little lower than the average return on capital in the sector, which means that my numbers collectively are creating a company for me that I'm okay with in year 10. Not in year 1, year 2, but in year 10. You know what I would not have been okay with as a number? If this had been 158.1%. What is that telling me? I have only 3 levers, right? Revenues, margin, sales to capital. So if I'm getting too high a return on capital in year 10, what's the message my own spreadsheet is delivering to me? You're not reinvesting enough, right? And what do I need to do to fix that? What's the number I use to reflect my reinvestment or estimate my reinvestment? My sales to capital ratio. So if I'm not reinvesting enough, should I lower my sales to capital or raise my sales to capital? I should lower my sales to capital. That will push up my reinvestment. Will push. Listen to your own valuation. I mean, when you look at your own, listen sounds like an odd word because spreadsheets don't talk to you, but they really are talking to you. Take a look at what your year 10 numbers look like for your company and ask yourself, am I comfortable with the company I've created with my own assumptions? And if you're not, fix it, because you're at war with yourself then. I hate to remind you of this, but your discounted cash flow valuations are due in about 2 weeks. I told you, 2 weeks and 2 days to be precise. They're not graded, as I said. You're going to turn in your DC. You haven't even picked a company, have you? No. Get started. Whatever you're doing, get it out of the way. Get that DCF valuation to me in 2 weeks and 2 days. And when I give you feedback, here's what I'm not going to give you feedback on. I'm not going to tell you I don't like your growth rate. It's your company. I'm going to let you pick the growth rate. I'm not going to say, look, your margin makes no sense, because it's your company. I'm going to let you pick the margin. I might not even contest your sales to capital ratio if that's how you're estimating reinvestment. But then in year 10, if you show me your company earning 220%, I'm going to ask you, what is so special about your company that you think it can earn 227%? And if your response is, what? That means something. So my job is to point out to you inconsistencies in your own valuation, where your growth assumptions, your risk assumptions, and your reinvestment assumptions are at war with each other. Those are the assumptions I can point to, because this is your valuation. I want this to be your narrative, not mine. So I'm not going to step in and say, I'm going to put my narrative on your company. But I'm going to ask you to be consistent with your own story for your own company. And that's what these measures do, is they allow you to keep that internal consistency. So let's summarize where we are with growth. There are 3 ways of estimating growth. The first is to look at the past, but why should we not just rely on past growth? Higgledy-piggledy growth. Enough said. You can look at what other people estimate as growth, analysts and management for the company, but why should you not just rely on analysts and managers? Because they're not that good. They're focused on something else. The third is to estimate your own growth from what the company does by looking at how well it reinvests and how much it reinvests, or using that sales to capital ratio. And I would strongly encourage to take ownership of your own growth rate. Because if you let somebody else's estimate of growth drive your valuation, then you really aren't doing this valuation. You're letting somebody else's numbers drive your valuation. You have to claim ownership of that growth and think about where that growth comes from. Okay? Any questions at all about growth? Now let's talk about that big number in every valuation. And you've seen it, that giant at the end that drives the entire valuation called the terminal value. First, let's set the table for why we need it. The value of an asset is the present value of the expected cash flows on that asset over its lifetime, right? The only problem is if you're valuing a publicly traded company, at least in theory, this company can go on and on and on forever. You cannot build spreadsheets with 16,000 years of projected numbers. You've got to stop somewhere. In fact, when you do valuation, the constant refrain you hear is, can I stop now? Can I stop now? Do I have to do an extra year? So you're looking for that closure so you can stop estimating cash flows. But you can't just assume the company falls off the face of the earth. So what we usually do is we estimate cash flows for 3 years or 5 years or 10 years. Then we stop and we estimate what's called a terminal value. So be very clear about what you're estimating, the value at the end of the 10th year. Now the question is, how do you come up with the terminal value? And there are 3 different approaches for estimating terminal value. One should never be used, but it's used all the time. And you can tell me which one it is. The second we tend to use much of the rest of the time, but maybe we should hold back on. And the third almost never gets used, at least in valuations that I see. So here are the 3 ways I know of estimating terminal value that I've seen people use. And you tell me which one is not consistent with an intrinsic valuation. What's the idea behind intrinsic value? That the value of an asset is based on its cash flows, growth, and risk. So which one of these approaches should never be part of an intrinsic valuation? First, you can estimate a liquidation value. What's a liquidation value? At the end of year 10, you shut your business down, you sell the assets for whatever people pay for it. Is that consistent with intrinsic value? Yeah, it's a cash flow. In fact, if you run a finite life business, if you have a toll road or you have a private business or you own a restaurant with a 20-year lease, guess what? At the end of 20 years, you can't assume you can sell the restaurant as a going concern to somebody. The lease is done. So liquidation value is perfectly okay, especially for businesses which have limited ambitions. So if you have a royalty trust, you know what a royalty trust is? You buy a share of an oil well. The oil well is going to run out in 15 years. Do a liquidation value, which can be very low. You can use a multiple of whatever you want. EBITDA, EBIT, book value, earnings, revenues. Half of all investment banking valuations, probably more. So if you've ever worked at an investment bank, and this particular table flips me out and I see it, so please don't send me your valuation of this table. Well, you have an EV to EBITDA that you've used to get a terminal value, and then you show this little table. If EV to EBITDA is 6, 8, or 10, this is what the value of your company will be. First, using the word value, we use an EV to EBITDA in year 10, is not allowed. Why do you use an EV to EBITDA of 6 or 8? Where do you come up with that number? You looked at other companies in the sector, you looked at what they trade. In other words, it's a pricing multiple. There's nothing wrong with pricing a company, but I call these Trojan horse valuations. Remember the legend of the Trojan horse? The Greeks and the Trojans were having one of the battles that went on for centuries. And the Trojans had surrounded this town. The town had incredible walls, I guess. The Trojans couldn't come through. So the Trojans decide to give a gift to the people in the town. Why would accept a gift from somebody who's been trying to invade you for the last 200 years? I don't know. But they give them this big wooden horse. And of course the people in the city are so happy. Gift, birthday. Wooden horse comes in. The gates close. And in the middle of the night, what happens? The back of the horse opens out. These Trojan soldiers come out of the back of the horse and the city falls. The Greek soldiers and the Trojans, I got them mixed up. So whichever side. So the Greek soldiers did the Trojans. So the Greeks were the smart guys, the Trojans were the dumb guys. Okay. No. You see what this has to do with terminal value? In intrinsic value, you show me it's all about the cash flows. And while I'm being distracted by the cash flows in the first 5 or 10 years, what do? You slip in a terminal number that came from a pricing multiple. This is a forward pricing. There's nothing wrong with it. We'll talk about how to come up with the right pricing for a company, but it cannot be an intrinsic valuation if 80% of your value is coming from a multiple, and that multiple came from looking at other companies and what they're priced at. So if you get a chance, if you worked in an investment bank in a previous life and you've saved some of the valuations, go back and look at them. You'll be amazed at how often these valuations rest on a pricing multiple in year 6 or 8 or 10 that's based on comparable companies. So if you have a chance, put a big X through that middle. Say never ever do this and call this an intrinsic valuation. So you cannot use a multiple. And of course that leaves us with the third approach, which is to assume your company goes on and on. A going concern assumption. When is that legitimate? When you have a company that's really a going concern, that's not going to stop after year 5 or 10, where liquidation is not going to be a best option, then you want to bring a going concern. And to value a going concern, what do you need to do? You need to make assumptions about what will happen to your cash flows beyond your terminal year, beyond year 10. And the most widely used approach, and I'll talk about why you might want to vary this for some companies, is to assume your cash flows will grow forever after year 5 or 10. And this is actually one of those things that people who don't like discounted cash flow valuations like to pick on. And they'll point out to an obvious fact: nothing lasts forever. True. So why do we make this forever assumption? Because once you get past about 40 or 50 years, you might as well go forever. You take a cash flow, grow it at 2% for 50 years, grow it at 2% forever, compute their present values, you get roughly the same number. The forever assumption is a convenience assumption, not an assumption we're all being incredibly optimistic about things lasting forever. So if you assume your cash flows last forever, that the growth rate continues forever, then the present value of the cash flows can be captured with a very simple equation. We act like we invented this in finance. But you know what? Mathematicians 200 years ago solved for this. It's an infinite series. If you write out the series, it's an infinite series where the numerator grows at G, the denominator is the discount rate, it's the same discount rate over time. You get that present value as the expected cash flow 1 year later. So if you're doing a cash terminal value in year 10, you always do the cash flow in year 11 divided by the difference between the discount rate and the growth rate. I've said this in corporate finance as well. This is the most dangerous equation in all of valuation. Do you see why? What's in your denominator? R minus G. Let's play a little game. You're an analyst, you're valuing a company, you come up with too low a value. Don't waste your time on growth in year 1. You go right to this equation. And then what should you do? Take the G and start moving it. Nudge it. You don't even have to move it very much. Nudge it. So you go from 2 to 2.1, 2.1 to 2.2. What's happening? The denominator is getting smaller, your value is getting bigger. And if you keep playing with the growth rate, I'm using that word intentionally, you're going to get Buzz Lightyear valuations to infinity and beyond. That's where you're going. Do you see why as G hits R, you are going to explode. But you have to remember that this is forever. And that brings in constraints. Because once you tell me this growth rate lasts forever, it's capped, right? Capped at what? It cannot be greater than the growth rate of the economy in which you operate. Because if you could grow at a rate faster than the economy forever, you would become the economy. So what I'm going to do is introduce 4 very simple rules that if you follow, the terminal value will stay within your control, because it's very easy to lose control of this number. So here's the first thing I'm going to suggest. The first is, when you get to that terminal value, you need to think about what growth rate can I use forever. And I said it has to be less than or equal to the growth rate of the economy. I'm going to give you a very simple proxy for that growth rate. Remember that risk-free rate you used to build off your valuation? That risk-free rate, I said, can be broken down into an expected inflation rate and an expected real interest rate. So file that away. That's your risk-free rate, expected inflation plus an expected real interest rate. What's the growth rate in the economy? The nominal growth rate. It's expected inflation plus an expected real growth rate in the economy, right? Compare those two equations. The expected inflation cancels out, and in the long term, and that's all we're talking about here, your expected growth rate and your expected real interest rate have to converge. It's an incredibly convenient result because it means it keeps your valuations in sync. And here's why. When we talked about risk-free rates, what did we say some people say about the risk-free rate right now? That it's too low or too high? That it's too low, it's amazingly low, we should do something about it. You know what I do when you get to the terminal value? If you think your risk-free rate is too low, then your growth rate also should be kept low, because what will get you into trouble is if you leave the risk-free rate at 2% and decide to go to a 4% growth rate, because then you're going to overvalue every company. The reason my valuation didn't implode on me with Ferrari when I went from dollars to euros is, remember, I changed the risk-free rate from 2 to 0.7%. But the spreadsheet is already, at least this version of the spreadsheet, I've kind of locked in your stable growth rate at your risk-free rate. So when I lower the risk-free rate, the growth rate in perpetuity also came down to 0.7%. Because if it had stayed at 2%, you'd have seen an explosion in the value of about 20 billion euros. Or 10 billion, I don't know how much, 20%, or 30% of the values. So it'd be 3 billion or 4 billion euros. And that's why you want to be careful about what you use as growth rates relative to your risk-free rate. So obey the cap. You'll have people trying to talk you out of this. Say, but this is company special. It's a global company. It's going to grow in China. That always helps a little bit. This is one of those rules you should never mess with. Okay? So keep that risk-free rate as an absolute cap, because it's one of the few things keeping your valuation from running away from you. Any questions on the cap? Yep.
Given that, like you said, you included the Eurozone or the US, that risk-free
Define whatever you define as your economy. I didn't say it was to be the local economy, right? So if you're a global, if you're Ferrari, you say, I'm not an Italian company. It's not GDP growth in Italy that determines how fast I grow. So once you describe it that way, then that's going to be the cap on your growth rate. It's not the domestic economy, it's whatever you define to be the economy. Right? But remember, over the long term, what's going to happen to all economies? Even if you say, I'm in the Chinese economy, I have a 10% real growth rate. Over time, just the small companies, as they get bigger, will see their growth rates decrease. The Chinese real growth rate will converge on the real growth rate of the global economy. It has to. When you're the second largest economy in the world, you can't keep growing at 8% a year. The global economy is growing at 2%. So the sheer math will mean that the growth rate has to become a relatively small number for every company, no matter how global it gets. So that's the first rule. Second, don't wait too long to put your company into stable growth. So last week when I valued Uber, I put a 10-year growth period on Uber. And I got an email back from somebody, or maybe it was just one of those comments at the end saying, how come you're using only 10 years for your growth period? It's a very high growth company, and I could see where it's coming from. You have lots of potential. Why not use 25 or 30? And the answer I gave was based on history, the history of growth companies in the US. There are actually these studies that look at how long growth lasts at a typical growth company in the US. I'm going to show you some of those studies later on. But the median growth period for a high growth company in the US is about 3 to 5 years. Remember that, it's 3 to 5 years. Across history, that's how long a typical growth company has lasted for. 10 years is about the 90 to 95th percentile of growth periods for a high growth company. Are there companies that have grown for longer than 10 years? Absolutely. And we can name them all, right? There's IBM, there's Google. What is the fact that we can name all these companies, tell you about these companies? They're the exception. And you know what happens when you value a company to be the exception? You've set yourself up for disappointment, right? This is like, looking at your kid saying, you're going to Harvard, or whatever your idea of, if it's not Harvard, replace whichever school. He ends up going to NYU. Oh my God, you're such a disappointment. So in a sense, don't say, if you set yourself up for what you feel is perfection and you build that into your value and you pay that value, then what the heck are you going to be surprised positively by? So here's how I think about it. If I can't make my money back in 10 years in Uber, then I'm asking for trouble. If Uber can grow for longer than 10 years, that's icing on the cake, and the icing should belong to me for picking the right company. So I've never done a valuation with a growth period longer than 10 years. No matter how promising the company looks, no matter how much pressure I feel from others saying you should use 35 years, because why value a company to be the 99.9 percentile? ninth percentile of the market, which is where you're going to put it at 25 years of growth or 30 years of growth. So that's my short defense for why I stop at 10. And even 10 is for exceptional companies. You give me a pretty large company and you say, well, how long will it grow? Let's say you ask me to value Toyota and you say there are good times coming. I'm not going to go past 5 years. So don't wait too long to start pushing your company into stable growth. Because if you wait too long, you're going to overvalue the company. And how long you can maintain this growth. And remember, for growth to create value, what does it have to do? It has to come with returns on capital that exceed the cost of capital. We saw that with that simple example. It has to tie back to what a company's competitive advantages are. There was a reason you took that strategy class. Even though you've been digging for that reason, here it is. Here's why we care about strategic advantages and competitive barriers to entry. The stronger and more sustainable the competitive advantages are at your company, the longer your growth period can be. When I sit down to value a young growth company, that's often the thing that I struggle with the most. Because it's still a young company, you got to figure out what those competitive advantages are. So you can think about what that might be for an Uber or an Amazon but what's Twitter's competitive advantage? 315 million users. That's it, right? They have a lot of people who are engaged. They figure out whether they can sell them ads is a different question, but that's a competitive advantage. Is it sustainable? Yes, it's really difficult to get people to attach to you as a social media company because there's so much competition. So if you look at a Facebook or a Twitter, you can make an argument that if they can figure out a way to make money off those users, it is going to be a long-standing value creator. In contrast, think about a company like Groupon. Even at its peak, when it went public, what was its competitive advantage? It got your email address a little earlier than everybody else, right? Which meant that if Groupon succeeded, you were going to get a bunch of competitors show up, and you saw that happening with Living Social Media and Amazon, deal of the day, very quickly dissipated. So I'm not saying it's easy to do, but when you look at a company, that's one of the questions you need to ask is, what is this company's competitive advantage? And the way it's going to show up is what kind of returns on capital you give them and how long you let them grow. So if you give Ferrari excess returns for a long period, it's easy to point to the competitive advantage, right? It's that brand name, 100 years of not 100 years, 60 years of racing, all that stuff, the celebrities connected to it, the why you'd want to be like Justin Bieber or Kris Jennings, I don't know. Kris Jenner, I guess, right? Kylie Jenner. I get my reality show. I don't know, but basically it's all that stuff that comes with it that allows it to maintain those advantages. So think about that when you think about how long you want the company to go. Third, just because you have a mature company, don't forget to reinvest. Amazing number of DCF valuations I see have the following concurrence of events after year 5 or 10. The company will become a stable growth company. It's a mature company. So far, so good. The operating income will grow at only 2% a year beyond year 10. Fine, right? In dollar terms, that's sustainable. And then the analysts would say, because this company is a mature company, we don't have to reinvest any money. That makes no sense, and we'll talk about why it makes no sense. But if you get to stable growth and you give me a 2% growth rate, you have the obligation to also tell me what kind of reinvestment rate you will need to deliver that growth rate. And actually, that's not difficult to compute if you think about the equation we had for long-term growth. Return on capital times reinvestment rate is expected growth, right? And if you're talking about forever growth, it has to come from new reinvestment. It can't come from efficiency. So if you're going to grow 2% a year and you have a 20% return on capital, how much will you have to reinvest? 2 divided by 20 is 10%. If you have a 2% growth rate forever and you have a 10% return on capital, you'll have to reinvest 20%. If you have a 2% return on capital, you have a 2% growth rate and a 5% return on capital, you'll have to reinvest almost 40% back. So you tell me your growth rate, you tell me your return on capital, I'll tell you what kind of reinvestment rate you will need in perpetuity. This is how you reward great companies. It's not by giving them 50-year growth periods. But you say, I'm stopping in year 10, this is a great company. I don't think its return on capital is going to drop off to its cost of capital after year 10, I'm going to allow it to stay above the cost of capital at 25, 30. And for Ferrari, I left the return on capital at 14.86%, which is a really high return on capital for an automobile company. But in its status quo, with selling only 8,000 cars and 9,000 cars, I think it can sustain that return on capital in its pricing power. And that's what I've built into the valuation. So think about your growth rate and your return on capital, and you will effectively get your reinvestment rate every year forever. Now, if any of you have read the McKinsey, how many of you have read the McKinsey valuation book? Our books came out at roughly the same time. Nobody's read nobody read the McKinsey book? Okay. The McKinsey valuation book is a corporate finance valuation book. It's actually from McKinsey. It's a very good valuation book. And it actually talks about consistency rules. And if you look at the McKinsey book, they make the argument that mature companies, the return on capital should be equal to the cost of capital. And the argument is not unreasonable. It says, look, no company can earn more than its cost of capital forever. So once you get to being a mature company, your return on capital should drop to the cost of capital. Now help me out here. If your return on capital is equal to your cost of capital, how much is growth worth? Don't think too long. If you earn your cost of capital on your investments, your net present value is 0. If your net present value is 0, then growing adds no value. So if I put a 2% growth rate and I assume the reinvestment rate is based on a return on capital equal to the cost of capital, whatever I gain by the growth, I will lose with the reinvestment. The growth will add no value. What if I make the growth rate 1%? No change in value. So if you look at the McKinsey book, the terminal value equation actually is NOPLAT, which is EBIT times, their version of EBIT times 1 minus T, divided by the cost of capital. There's no growth in the equation. And I get emails from people reading the McKinsey book saying, how come there's no growth in the McKinsey? To which my response is, email McKinsey. Why the heck are you emailing me? We're not connected at the hip somehow. Okay? But actually, it's one of these easy questions to answer, so I usually answer it. It's because McKinsey assumes that return on capital is equal to the cost of capital. Once you make that assumption, why even waste your time estimating growth in perpetuity? So the only time it actually makes sense to even think about growth in perpetuity is when you make the assumption about return on capital being above the cost of capital. And I make that assumption about 40% of my valuations, I let the return on capital stay above the cost of capital. And the reason being, I stop in 10 years, right? And while growth tends to drop off very quickly in 10 years, and that's what the first graph, the second graph actually looks at from a McKinsey study that looked at growth. It shows that growth drops off. Returns on capital for companies stay elevated for much, much longer periods. So this is actually from a McKinsey study that looked at how much returns on capital, how returns on capital changed over time versus growth over time. Growth tends to drop off. That's a 10-year limit, but return on capital stays high. So McKinsey's own study tells us that assuming that return on capital is going to be equal to cost of capital after 10 years can be a dangerous assumption. So if I assume that Ferrari's return on capital is going to drop to its cost of capital after 10 years, I'm essentially saying that 10 years from now, we're all going to wake up and the brand name is going to have completely dissipated and we're not going to be able to make excess returns in this company. And that seems a little extreme. So I like to preserve the discretion as an analyst, but remember that discretion still has to be thought through. So when you do your valuation, I will ask you, what do you want your return on capital to be in perpetuity? And I want you to think about that answer rather than saying, why is he wasting my time by asking for one more input? I want you to think about what your company will look like after year 5 or year 10, because that's what's going to drive how much I reinvest beyond that point in time. So let's review. You want to make sure you obey the cap, which means your growth rate should never exceed your risk-free rate. Don't wait too long. So don't have 25-year growth periods or 30-year growth periods because that's asking for trouble. And third, make sure you reinvest as you grow. And let's talk about why these analysts assume that CapEx offsets depreciation. That because you're a mature company, you don't have to reinvest. Why that can never hold. So here's how it will work. The analysts will say 2% growth forever. But because it's a mature company, CapEx offsets depreciation. It's called maintenance CapEx. So what's your net CapEx if CapEx offsets depreciation? It's 0. And they'll say there are no working capital needs, which means the change in working capital is 0. 0 plus 0 is 0. Hang in here. It's going to get really messy now. 0 divided by any number is 0. And 0 multiplied by any number is 0. 0 is a great number. But if your reinvestment rate is 0, which is what you've assumed, what's the only growth rate that's consistent with the reinvestment rate of 0? Come on, 0 times any number is 0. The growth rate has to be 0. So if you use a 2% growth rate and you make these assumptions, you're just violating the 0 times table. And that's a table that none of us can afford to violate. I'll even tell you one little qualifier that these analysts will say, but what if I could just raise prices by the inflation rate? Is it then okay to make these assumptions? Do you see where they're going? My capacity is going to stay the same. I'm going to sell the same number of units. All I'm doing is raising prices. That means I don't have to reinvest, right? What should your answer to that be? Your prices are going up by 1% a year, so you're putting that as a growth rate. But you have to replace your assets in your existing factories, right? So those old machines will run out and you're going to replace them with new machines. So what's it going to cost you to replace those old machines? In other words, if you count on inflation as pushing up your cash flows, your existing assets, when they get replaced, will also go up. There is no escape hatch. That's all I'm saying, is you can never have a growth rate greater than 0 and no reinvestment to go with that growth rate. So again, take a bunch of DCF valuation that you see people that you might have done. It's okay. Take your own valuation, see if you've made that assumption. Think about what it means in terms of value forever. And finally, you give your company the growth rate of a mature company. Make it look like a mature company. What do I mean by that? Its cost of capital is going to have to come down to that of a mature company. So if I'm valuing Uber and right now I say, look, my cost of capital is 12% because it's all equity funded and it's a risky business, I'm okay with that. But in 10 years, I'm telling you Uber is making $4 billion as operating income. It's growing at 3%. It's a mature company. Then I can no longer leave the cost of capital at 12%. I've got to bring it down to the cost of capital of a mature company. In 2015, the cost of capital for a mature US company was between 7.5% and 8% in US dollar terms. So if your cost of capital is much, much higher than that, and you've made your company a mature company, then you got to think about how you justify leaving that cost of capital where it is. And that's why if you look at that, the valuation spreadsheet, I ask you that question. Do you want me to bring it down to that of a mature company? And if you say yes, I will. If you say no, I say, okay, do what you want. That spreadsheet gives you enough rope to hang yourself if you want to. So that's what those default questions are. I won't force it on you, but you know what? If you want to do something else, be my guest. But think through why I'm asking you those questions. It's precisely to get that. So keep that in mind. So everything has to reflect that, which effectively means that the cost of capital you have in year 10 will be for a very different company than the cost of capital that you have today. So it's risk-free. You can even change the risk-free rate if you want, as long as the growth rate changes with it. Your beta might change if your business mix changes. Your equity risk premium might change if you think your company is going to be 80% China-based in 10 years. You get another chance to revisit every number in your valuation. And your reinvestment has to be based on what your growth rate and return on capital are. So that's pretty much discounted cash flow valuation, all the pieces. You have everything you need to do discounted cash flow valuation, because next session when we start, we're actually going to cover what I talk about bringing models together and loose ends in valuation. But try to get your discounted cash flow valuation started and moving if you can this weekend. We're okay. Everything got picked up. The quizzes were mostly picked up.
So we will do DCF in this session coming up.
That'd be great. Especially terminal value. That'd be great, because spend a lot of time on terminal value. Do the weekly challenge. Actually, that'd be a good idea. The weekly challenge for this week is built around terminal value. To take the problem apart, because it shows, first it gives a growth rate and a return on capital. So it's actually a great way to bring it home, is to bring on that connection between growth and reinvestment rate.
In the interview where I said you got to use your growth rate.
Well, then never please. It's okay. You got to deliver the truth, even if it hurts, right?
Quick question. Yes. flows can be nominal or real, right? And we've calculated the discount rates, and those are nominal or real. So we didn't really talk about nominal or real growth rates, but it strikes me that there is a growth rate in nominal cash flows and a growth rate in real cash flows.
Why would it matter? Let's suppose I took the Ferrari valuation in real terms. The real risk-free rate is 0.4%. It's a tips rate. With 4.4%, what's going to happen to my growth rate? I'm going to take out even the little inflation I put in for euros, so the 4-point-something percent is going to become 3.7%.
Right.
My perpetual growth is now going to drop to 0.3%. Guess what's going to happen to my terminal value? Absolutely nothing. Think of real as just it's a continuum, right? It's like having a currency with zero inflation.
Right.
That's basically all it is.
Yes.
So real basically means that there's no inflation in your
Yes.
cash flows, no inflation in your discount rate. It can't help you or hurt you to go from nominal to real. The only problem with real is nobody pays taxes on real income. So the problem with real discounted cash flow valuations is the tax rate you pay will no longer come from the tax code. It's got to be a computed number. It's not a big deal when you're working euros because you're close enough, but if you have a 15% inflation rate,
Yes.
and that's why if you can, it's probably better to do things in nominal terms because the world operates in nominal terms.
Exactly. So, which is exactly why I was going to ask, so if you're looking at a company in India and where you have higher inflation, the growth rate's going to still look very similar to a real growth rate.
You mean the nominal growth
The
rate?
nominal growth rate, yeah.
If you have high inflation, how can the nominal growth rate be close to the real growth rate?
So, I
It
mean,
should
I
be
was
very,
just-
it should be
yeah,
very different.
Very different. Exactly.
Very different. It should be very different. It should be about 10. If your inflation rate is 6%,
Right.
your nominal growth rates are going to be very high, which is part of the reason if I take an Indian company and I've done what I did with Ferrari, which is do all my growth rates in rupees and in the last moment switch to a dollar cost of capital.
Right.
The value would have exploded
Right.
because I'd have built in this. It's really about what so forget about currencies, real nominal. Here's what you have to make sure that the inflation you build into your cash flows
Right.
and the inflation you built into your discount rate have to match up.
Right.
If you do that, then all is forgiven.
Right.
Right? That's the only job you have in valuation, to make sure that those numbers are consistent with each other.
Right. I mean, the thing
Yeah.
I was trying to understand clearly was that when you flipped that to the
Right.
risk-free rate from the euro to the dollar,
Right.
I was thinking if you'd have flipped it to an Indian risk-free
Then my
rate,
risk-free rate would have jumped, my growth rates would have
would have
jumped
jumped as
by
well.
the differential inflation.
Right.
My value would not have changed very much because what one hand gives you, the other hand takes away. My growth rates would have been higher, so that's good. My discount rate would be
Would
higher.
have been higher as well.
So
the
that's
difference-
why as long as you're internally consistent, so I could go nominal, I could have gone to a real, I could have gone to Indian rupees, I could have gone to a 20% inflation currency.
Right.
Everything kind of scales up or down, both in the numerator and the denominator, and that's the key thing to do, is to make sure that they're all
Understood.
consistent.
Thank you.
So,
See you later. Professor, how are you?
good, how about you?
I'm all right. So I'm a part-time student.
Yeah.
I took your class last semester. Great classes, by the way. The issue is my boss just quit, and he's the only one that knew that I was taking this class in the middle of the day.
Take
so
it online, don't worry about it.
yeah, it shouldn't be a problem. I'm gonna still try to get here.
The
but
quizzes,
he was the only one.
quizzes might be the only time you have to be able. It's a 30-minute quiz.
Right, I could take a
November 14th.
PTO half day or something like that.
You don't even have to take a half day. You just have to leave for an hour. And
Sure.
whatever.
Should get interesting for me now. Although I might get his job, so that should be good.
That should be good. Then you'll be your own boss, and you can tell him.
Giving myself a break there. Exactly.